everybody, Dave here, Hidden Freedom Investing, and today we're going to go over my dividend portfolio. All right, it's been a crazy month with the coronavirus and all that, and the markets basically went down quite a few days in a row, got everybody freaked out, and I took advantage of that. I bought some positions during that week, and some stuff got crushed because of earnings, and I bought some stuff because of that. But in general, I've bought quite a bit of stuff through the month of January, and we're going to go over my dividend portfolio update for the month of January. If you have not seen my last video that I did, basically my dividend portfolio review or reveal, then go ahead and take a look at that video here. Kind of starts out introducing the portfolio, and so anyways, we're going to do an update for the month of January. We're going to see how the monthly updates do, and see if we need to go to a weekly update, but I think in general, I think a monthly update will work best, so we'll just keep it at that format for now. We're going to look at the buys, we're going to look at the dividends and all that stuff, so let's go ahead and dig into the portfolio. So here we are looking at Google Sheets. This is where I track my dividend portfolios, because this actually is representative of two portfolios within Schwab, and I basically aggregate them down into one view here. So a lot of times what it is if it's 3 shares in one, it could be 3 shares in the other, but one account is going to be growing faster than the other because I have limited funds in my retirement that I can have access to on the retirement tax deferred side, so that side will be growing a lot slower than the taxable side. So right now, as you can see, there is 32 positions in my portfolio here. So 33, and you minus that one up there, it comes out to 32 positions. And if you saw my last update, I had 30 positions total. And for the month of January, I added 2 new positions, and those 2 positions are GPC here and DUK. Now I think GPC is called Napa as well. Maybe a lot of people know it as Napa. I know them as Napa, but I could not resist buying that. They had a little bit of a pullback. Quite a big of a pullback actually off of earnings, so I figured I'd pick that one up here, and that one is a dividend king, so how could I go wrong with that? Payout ratio super low, and the starting yield was 3.1%, at least when I picked it up, so I couldn't go wrong with that, so I kind of added that to the portfolio. And if you saw my last update, I pretty much said I was never going to probably go above 35 positions, and I still think that's about right. I like to probably add Apple to this particular portfolio, maybe IBM, just because I want to get a little bit more yield out of the tech industry or tech sector. I'm not really sure if I'm going to add IBM yet. IBM is just one of those companies that's it has a good yield. It's it's a decent price. Of course, the last week it's gone up, but because the CEO, I think they actually are going to kick out that CEO in I think April, they said. So I don't know if I'm going to add IBM to this portfolio or not. Right now, I'm kind of leaning towards adding it. I'm kind of curious what other people would say. You could say, what's the dividend history on it? Well, the dividend history is not very good, but at the same time, neither is Microsoft and neither is Apple. So, as a matter of fact, IBM has a better dividend history than, Apple and Microsoft. So, I'm not really sure. But at this time, I did add DUK as well. And I have quite a few, utilities here. If you want to take a look at my utilities, basically the reason why I have quite a few utilities, and you can see I already have 4 utilities in this portfolio. Now I could see myself probably adding maybe NEE in here, and the reason why I want to diversify in utilities and specifically in a couple other sectors, probably like financials, is because I got burned off of PG&E a couple years back. Bought it in like the 70s, and here it was dropped all the way down into like the $16 range and lower, and I think I sold it in the 40s, but it just they got rid of the dividend and all that, and you could really get hounded on some of those. So why not diversify across more utilities? As you can see, the dividend yields and all those are pretty good. So to me, look at the last 4 down here. There's only one aristocrat in there, and that's ED, so That's going to be probably my main one I'm going to go to. And none of the other ones are even close. Look at that, 46 years in ED, and all the rest of them are just, 19 years is the next closest one. So NEE is a good one as well. It's just a little overbought right now, quite a bit overbought in my opinion. So I won't be adding that one anytime soon, but I could see myself adding another utility in general, and hopefully it could be that one. But those are the only two new additions that I made to this portfolio. So that was DUK and GPC, and it brings my total up to 32 positions. Likely I'll probably add Apple to this eventually. Now this yield's gonna bring down my yield, but what else did I buy in the month of January? Well, I bought quite a few things. As you can see, my last dividend portfolio update, I was at $50,000 and I'm at $61,500 now. So basically I added over $10,000 in total to the two portfolios. Now most of it went to the taxable account. So I brought my dividends up to $2,000. So if you haven't seen my video on my 2020 goals, I wanted to have a goal of making my dividend income of $2,000, and here it is, basically the end of January, and I've already met that goal. So I'm going to surpass that goal. I have plans to get this account up to 100,000 plus this year, and maybe even more than that. It just depends on what's going to happen in the market. If I see deals or anything like that, I'm going to go ahead and swoop them up, and within reason, I'm going to try to keep my sectors as balanced as I possibly can, weighted towards what the S&P 500 is weighted towards, and we'll look at that here in a second. But so let's go ahead and look at the purchases that I made in the month of January. And right here, we're looking at my Schwab account, and this is all the purchases that I made in my taxable account in the Schwab account. So in a minute here, we'll swap over to the tax deferred account. And I didn't make a lot of purchases in that account, obviously, because there's limited capital that I can even put into that account. So as you can see here, I bought a lot of stuff through this month of January here. And there's even another page here that's 9,300 on that page. As you can see here, there's a bunch of different buys for a lot of different tickers, and as you can see also that I'm not buying a lot at the same time. I'm just buying one share here, two shares here, one share, two shares. Here DUK, that was when I added that position, so I added 4, so a little bit larger, right? In AT&T, I figured I wanted to get this account to be kind of matching what the tax deferred account was, so I kind of went in with 10 shares there. But as you can see, most of the positions that I added to were positions that were either had a down day because of the coronavirus, or they had bad earnings. Like Wells Fargo had bad earnings, and just just in general, Wells Fargo is having trouble. Now there was a couple other ones as well that were having issues, but as you can see, I'm not adding a lot of stuff at one time. It's just 1 or 2 or 4 shares here and there across depressed stuff. I even added a Microsoft there, and here we're at 52-week highs on Microsoft. Added some more 3M and stuff in there. So I am taking it easy. I went kind of overboard in the month of January, but we did have a pretty good pullback in the month of January, like 3 or 4%. It's not even a real big pullback, but it did freak quite a few people out, and I took advantage of that. When there's blood on the streets, I'm going to go ahead and be a medic, and I'm going to go out there and repair all those depressed stocks. I'm going to buy them up. So let's go ahead to the next page here. So the next page, we just had a couple of cats in a Wells Fargo. So that was January 31st. I picked up one share of that Wells Fargo. So about $9,600 I added to that account. So let's go ahead and look at my tax deferred account here. This account really, like I said, is limited in funds because it's a retirement account and I don't have access to my 401k or anything like that. But I do have monthly contributions that I do make to this account. So I will be adding to this account. It's not going to be as aggressive as my taxable accounts. So even still, for the month of January, I added those 2 new positions, GPC and DUK, to this account as well. In addition to that, I bought 1 Wells Fargo, and I also bought some more realty income because this is the only account realty income is in. So I added 5 more shares to that as well. So for a total of $700 added to this account. So that brings the total to a little over $10,000 that I deployed in the month of January. I'm not going to look at the capital gains for these accounts. I don't really care about that. I don't even track it. I don't even look at that page in Schwab. All that really matters is that I'm adding money to this account and the dividends are being reinvested. So, and as you can see here, down at the bottom, we have a total of 61,500 in there now, and the dividends are up to 2,065. Now, I had one dividend received for the month of January because, I just started these particular accounts, so I don't have a lot of dividends for the month of January, but I do have realty income that I received, and that got reinvested. Now, I had not done an update yet to that in the spreadsheet. I wrote a script, and let's go ahead and run an update, and I'm going to kind of walk you through this at the same time. So what I did is I went into Schwab, and there's a kind of a view where you can look at both accounts in there, and you can export a CVS file, and then I wrote a Schwab Python script here. I call it Schwab to Google Sheets, and what that's going to do is that's going to go ahead and take all of the positions for the two portfolios in Schwab, export it into CVS, and then from there I run the script, and that will update Google Sheets automatically for me, which makes it so much easier because I don't have to take all those fractional shares and do a calculation in my calculator or anything like that to be able to populate the spreadsheet. So if it was whole numbers, it would be a little bit easier, but anyways, so let's go ahead and run the Schwab to Google Spreadsheets update here, and that should update the realty income, which currently showing 24 shares, and basically that got reinvested just in that tax deferred account. So let's go ahead and run an update here. And there it goes. It looks like the script finished and it populated 25.0447, and what it did basically is it read what was currently in there and then took my two portfolios, added them together in Schwab, and then calculated the difference there and then updated it if it was a difference. So that makes it a lot easier for me. All I got to do is either once a month or however many times a month I want to do it, but once a month here theoretically is I just go into Schwab, and there's like a positions view in there that you can go to, and if you have two accounts or one account, it doesn't really matter. You can do an export, and then from there, this script will just basically take that CSV file and then run through here, grab all the positions, and then do the calculations for me. So it makes it so much easier for me. Now, granted, it would be a lot easier if Schwab actually had an API, because I could just query their API into my account using a key, and then everything would be automated. I'd probably just run a cron tab job or something like that on my Linux server. But this is still a lot easier than going in there and manually populating it, because I had this one down here manually populated. It was a pain in the butt going in there, adding everything to accounts, getting the calculator out, because it's fractions of a share, so it just made it a lot easier to do that. So it looks like the Google API is having a little trouble here, and it's kind of just the way that Google API is. So right now, looking at this account, so yeah, the weighted beta is 0.74 across the whole portfolio, and I have a lot of utilities in there and all that, so I'm pretty happy with 0.74%. The beta actually is 0.73, but the weighted beta is 0.74. So, and the average market cap is $178 billion across all those. There's some, the big company, and there's a $1 trillion company in there, Microsoft. So sometimes what I'll do is I'll actually sort these by the percentage on the day that it's changed, and I'll look for the things that are depressed the most. Like in this case here, GPC had the biggest decline on the day, and sometimes what I'll do is I'll actually look at this during the day and then use this as a gauge to figure out what I want to buy for that day or that week. But I do track these in another account of mine daily that I'm looking at daily. I don't necessarily look at this particular spreadsheet daily, but it could be a way that you could actually track things, and if you want to buy them, going by the 52-week high here and the 52-week low here. I did change the colors on those as well. They were like dark blue last time, so what I did is I changed this column to be red if it's within 5% of the 52-week high, and then I changed the 52-week low percentage to be 5%. So I changed that to be green. So there's only two things that are in the green right now and not in the red. and that's just ExxonMobil and Chevron, and you know, those have had a really tough week and tough month, tough year, and I don't really plan on buying any more of those. Right now they're right where they need to be. So let's go ahead and look at basically my yield. So the average weighted dividend yield is 3.3%, and you know the yield across the whole portfolio is 3.3. I'm actually a little bit higher than that on the average weighted yield, so that's pretty good. I'm pretty happy with that. Those utilities and you know some other stocks in there that I've kept in there. Now we'll look at the allocations in a minute, and the average weighted 5-year dividend CAGR is 7.8%. I think that's pretty close to what it was last month as well. So the allocation right now, you know, so financials is still pretty good. It's still a little low, but you know, as you can see, this consumer discretionary and consumer staples has come down a little bit. Utilities is still a little high. Compared to the S&P 500 at the 3.3%, and I'm okay with that right now. So the biggest thing you notice here is the information technology is still only 5%. So the only thing I really have in there right now is Microsoft and APD or ADP. Now ADP I don't really even count as a technology company, but so like I said, I probably will add Apple to this account eventually, and probably even add IBM eventually as well. So that's a look at the actual percentages for the sectors, and you know, just you know, looking at the income by sector here as well. As you can see here, it looks like the highest is energy, and consumer staples right now is being probably the #1 income producer for me. So income, you know, is basically $320 per year, and the next one would be energy. So the allocations are still a little out of whack, and until I get more technology in this portfolio, bring some of those percentages down and kind of see where I'm going to be at. Now things are never going to be probably perfect until I get to where the maximum that this portfolio is going to be, and I have a feeling this portfolio is going to be about $700,000 in the next few years. Could take a little bit longer than that, just depends on those, you know, how quickly those notes bleed out. Some of those people could keep those things for 10, 20 years, so it could take a while. But in general, I will be growing it pretty aggressively, so that is the update with this portfolio. If you have any questions or anything like that, you want to, you know, kind of get yours set up, or you can do a script update or something like that, you know, go ahead and shoot me a comment or something like that. But for now, I think we're going to leave this portfolio update here, and we'll go ahead and do another one for February. So I hope everybody had, you know, kind of made it through that coronavirus. I know it's still going on, but the market has recovered. So anyways, with that, let's go ahead and end this video. I appreciate everybody watching, and go ahead and like, subscribe, and we'll see you in the next video. Thanks for watching.